Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, welcome back to the Internal Reconstruction chapter. Now in the previous three videos we have seen the concept of internal reconstruction, journal entries, and we have also seen a simple problem of internal reconstruction. Yes, now here in this fourth video of internal reconstruction we are going to see this big problem, and especially we are going to see how to prepare the balance sheet. Yeah, that's the main thing, vertical balance sheet. Yeah, so let's start. See the question over here. The balance sheet of Nischal Limited as at 31st/3/2017 as follows. Yeah, the balance sheet, horizontal balance sheet is given. Liabilities, assets. In liabilities, as you can see, we have got two capitals here: equity shares, preference share capital, debenture is there, outstanding interest, bank overdraft, sundry creditors. And in asset, as you can see, goodwill, land and building, plant and machinery, furniture, patent, stock, debtors, cash and bank. And then we have got profit and loss account. Now what is this profit and loss account? This is loss, isn't it? Yes, the profit and loss which is shown on the asset side is what? It is loss. Yeah, if you get a vertical balance sheet in your question, then this will not be in the asset side. This will be where? This will be in the reserves and surplus as a negative figure. Okay, this is loss. All right, yes. Now then what we have got, see here, scheme of reconstruction. Now they have given us what all things are going to be done to save this company, this Nischal Limited, from getting liquidated, right, going bankrupt. So see here, the 12% preference shares are to be converted into same number of 15% preference shares of ₹75 each, fully paid up. So here they are talking about change in the face value. Yes, change in the face value, as well as the percentage of dividend is also going to be changed. So we'll see all this. This is the scheme of reconstruction. There is equity share scheme is there, and then debenture holders regarding debentures, and then creditor, land and building is there. Yeah, so many things are there. We are going to see that while solving the problem. Yeah, now let's not waste the time here. So then they have said you are required to prepare a reconstructed balance sheet. Right, let's start this. Let's solve this problem. Now let's solve this problem. So first we have to pass the journal entries. On the basis of journal entries only we will be able to prepare the reconstructed balance sheet. Yes, so journal entries in the books of Nischal Limited. So how are you going to do that? How are you going to pass the journal entries? It's very simple. You have already seen the format and everything. Yeah, so see here, what we have to do is we have to see the scheme of reconstruction which will be given to you in the question. Yeah, what is happening, how they are trying to save the company. With each thing that is happening, you have to pass a journal entry. So the first thing, see here, what is happening, the 12% preference shares are to be converted into same number of 15% preference shares of ₹75 each, fully paid up. So here what is happening, the paid up value is not getting changed. Yeah, only the face value. See here in the balance sheet, 12% preference shares of ₹100 each, fully paid. Yeah, so we had 12% preference shares and the amount was 12 lakh. Yeah, and the face value was how much? Face value was 100, isn't it? Face value was 100. So 12 lakh, yeah, 12 lakh is the amount, divided by the face value, then 12,000 were the what? 12,000 are the number of preference shares. So now here in this scheme they are saying that number are not changed. Yeah, number of shares are not changed, converted into same number of, just the percentage is getting changed. From 12% it is becoming 15%. That's the rate of dividend, fixed rate of dividend is getting changed. Yeah, now from 12 it is becoming 15, and their what? Face value is getting reduced. Their face value was 100, now it is becoming how much? 75. So simple. Whenever there is a change in face value, reduction in face value, what you have to do is whatever preference share capital is there in the balance sheet, scrap it off, completely cancel that. Yeah, so journal entry would be very simple. See here, the entry would be what? First you have to scrap off the old capital and create the new capital. So to scrap off the old capital, what are you going to do? See, preference share capital is what? It is equity. To scrap it off, to reduce it, you have to debit, isn't it? So the entry would be very simple. See here, 12% preference share capital, whatever that was there in the balance sheet, the old capital, 12 lakh debit, you have reduced that. Yeah, and then you have to create new capital. If you want to create new capital, then you have to credit. Yes, so to 15% preference share capital, you see they have said percentage has been changed. From 12% it has become 15%. Yes, so to 15% preference share capital account. But now what is the value that you have to take? They have said that the face value has been changed, isn't it? 75 rupees now. Before it used to be 100, now it is 75. Yes, so how are you going to calculate that? It's very simple. We know that before the face value was 100, yeah, and the amount that was given in the balance sheet was 12 lakh. Yes, so the number of shares were 12,000. So 12,000 number of shares, that have not changed, yeah, that is not changed, that is same. So 12,000, the new face value is 75. If you multiply those two together, you get 9 lakh. So 9 lakh is your new preference share capital of 15%, and the face value is 75. Understood? Right. So from 12 lakh, the capital has been reduced to 9 lakh. So now the company has made a gain of how much? 3 lakh. Yeah, how much? 3 lakh. So that gain, that balancing figure has to go to where? Capital reduction account, the temporary account which we open to carry out the scheme of internal reconstruction, isn't it? Whatever gain that we are going to get in this scheme, we are going to transfer that to capital reduction. Yeah, capital reduction account will be credited. Fine. So the first thing is over. Yeah, change in face value. So what you had to do was, you had to scrap off the old capital and create new capital. Yeah, simple. And then the balancing figure went to capital reduction account. Fine, simple as that. Yeah, then the second thing, B, the equity shares are to be converted into same number of equity shares of rupees 5 each, fully paid. Now here what they are saying, the equity shares are to be converted into same number of shares. Number of shares are not going to change, but the face value is changing. See here, equity shares are becoming 5 each. It is fully paid only, so paid up value is not changing. Face value is changing. Whenever face value changes, scrap off, completely cancel the old capital. See here, equity shares of rupees 10 each. Face value was 10, and they are saying now we have to make it 5. Yeah, here also it was fully paid. Here also it is fully paid. So the paid up value is not changing. The face value is changing from 10 to 5. So scrap off the old capital. Simple. The entry would be what? To scrap off the capital equity, you have to debit the old capital. Simple as that. And whatever you want to create, whatever capital that you want to create, credit that. Simple. So see here, equity share capital account. Yeah, so whatever that is there in the balance sheet, equity share capital of 10 each, yeah, 12 lakh. The value of equity share capital is also 12 lakh. The face value is 10. So now debit that, completely cancel it off. Yeah, equity share capital, they always have credit balance. You are debiting them to cancel it off. Debit it. Then you want to create new equity share capital of what? Face value 5. Simple. To equity share capital account. Now you need to know what are the number of shares. Yeah, that's how you are going to take the number of shares into the face value. Then you will only get the amount. So easily you can calculate the number of shares. That's not a big deal. See here, equity share capital, how much? 12 lakh amount is given there. Yeah, in the balance sheet. So 12 lakh divided by the face value 10. So number of shares is how much? 1,20,000. Yeah, 1,20,000. And they have said number of shares are not going to change. Yeah, number of shares are same. So easily we can take that 1,20,000 into 5, 1,20,000 into 5, then we get 6 lakh as our amount of new equity share capital. Simple, credit that. Yeah, so what are we going to do? 1,20,000 shares. Yeah, that has not changed. The shares are same only, 1,20,000 before, now also 1,20,000. The face value is changing, so multiply that. 6 lakh would be your amount of new equity share capital. You credited it to create it, right? You're creating the capital. Yes, then whatever that balance will come, it will go to capital reduction account. Before it was 12 lakh, now it has become 6 lakh. So the difference is of 6 lakh. Yeah, so that would go to capital reduction account, that gain. Simple, right? Then the third thing, see here, C, debenture holders agree to forego interest outstanding subject to the condition that the rate of interest to be increased to 15%. Now here what is happening? See here, in balance sheet we have got debentures. Yeah, so now we as a company, we have made a deal with the debenture holders. We have said to them, see, the company is going to get liquidated. We have to save the company. So what you have to do is, whatever interest that is outstanding, yeah, we have interest outstanding, whatever that is interest that is outstanding to you debenture holders, please forego the interest. Forget about that interest. Yeah, so let's settle it. So now what they are going to do is, they are not just going to forego that interest. They are saying that, okay, we will forego the interest. Okay, you don't have to pay the interest, the debenture holders are saying, but there is our condition that our rate of interest has to be increased to 15%. Their rate of interest currently is 10%. Yeah, now they are saying we will forget about our interest that is outstanding from you people. Yeah, if you increase our rate of interest to 15%. So simple, rate of interest of debenture are changing here. Yeah, from 10% it is becoming 15%. Simple. What you have to do is you have to cancel off the old debentures and create new debentures. Fine, it's very simple. But first what you have to do, forego the interest. You have to cancel the interest. Yeah, this liability which we have in our balance sheet, yeah, we have to pay the interest on debentures. The debenture holders have accepted to forego the interest. Yeah, they are gonna forget about the interest. We don't have to pay them any interest. Yeah, it's 80,000. So first let's cancel that liability. Outstanding interest on debenture account, debit 80,000. Why did I debit outstanding interest on debenture? Because our liability is getting reduced. Whenever our liability reduces, we debit that. Yeah, so that's why outstanding interest on debentures account, debit 80,000. We don't have to pay that. Debenture holders have forgotten about the interest now. Yeah, they have foregone the interest. So now we are gaining by this. We don't have to pay 80,000 now. So that is a gain, and in internal reconstruction, whatever gain we have, that goes to capital reduction account. So outstanding interest on debenture account, debit, our liability is reducing, debit, yeah, we are cancelling off that liability which we had in the balance sheet, outstanding interest, cancelling off. Yeah, so that's what we did. Yeah, outstanding interest on debentures account, debit 80,000 to capital reduction account. The gain will be transferred to capital reduction account. Fine, simple. And then what, here only there's one more entry in this transaction. Yeah, in this scheme there are two transactions. What is happening here? The first thing is interest is foregone, so entry for that. Yeah, we are gaining, we transferred that gain to capital reduction. But then what is happening? We agreed to the condition of debenture holders, yeah, increasing the rate of interest from 10%, we have to increase it to 15%. So what we have to do, cancel off the old debentures. Now what is debentures? Debenture is like a loan, right? It's a liability. To cancel the old debentures, you have to debit that. 10% debentures account, debit 8 lakh. It is given in the balance sheet. See here in the balance sheet, see 10% debentures 8 lakh. Yeah, you have to cancel off these debentures and create new 15% debentures as given in the C question. Yeah, 15%. So cancel off the old debenture, the old liability 8 lakh. Yeah, and create new debentures to 15% debentures account 8 lakh. Now from this transaction, yeah, we are not getting any gain, right? From 8 lakh, it's 8 lakh only, and liability is not getting reduced. So there is no chance of going anything to the capital reduction account. It's simple. Just the rate of interest has been changed. The amounts are same only. Yeah, from 10% it became 15%. Just the name of debentures. Yeah, the interest rate which they get, the debenture holders. Yeah, we did that because of foregoing the interest, isn't it? We made a deal with the debenture holders. That's what. So in this C question, there are two entries here. Fine, simple. Cancelling of the old debentures, creating the new debentures with the same amount, just the change in the percentages. Fine. Then move on. DC here, creditors agree to forego 25% of their claim. Now here they are saying that we have made a deal with the creditors to save the company. We have asked the creditors to forego their claim. Yeah, whatever we have to pay them, forego some amount. So creditors agreed to us. Yeah, they made a deal with us and they accepted to forego 25% of their claim. So our liability to creditors is getting reduced by 25% as said in the question. 25%. Fine, it's very simple. Just reduce the creditors by 25%, and whatever gain that we are going to get, transfer that to capital reduction. See, it's very simple. Our liability is getting reduced by 25%. Creditors, liability reduces, you have to debit that. Simple sundry creditors account, debit. Yeah, what amount? 25% of their claim. Their liability is how much? Our liability to creditors 3 lakh, isn't it? So simple, calculate it. 3 lakh, yeah, into 0.25, that's 25%. Yeah, so if you do that, it is how much? 75,000. So 75,000 of our liability to creditors is getting reduced. So that's a gain to us. We are gaining by it, and gain is transferred to capital reduction. Sundry creditors account, debit 75,000 to capital reduction account 75,000. Simple, easy peasy, right? Then see here, land and building. Land and building is valued at 15 lakh. Yeah, land and building is valued at 15 lakh. Now let's see the balance sheet value, the book value. Here, if you can see here, land and building is of 12 lakh in the balance sheet. The book value is 12 lakh, and here what has happened, the land and building is valued at 15 lakh. The value has been increased by 3 lakh. From 12, yeah, from 12 lakh it has become how much? From 12 it has become 15. So we have an increase of 3 lakh. Yeah, increase of 3 lakh. So that increase is what? Gain on revaluation. Yes, it's a gain. And what do we do with the gain in this internal reconstruction? If you are getting any gain, transfer it to capital reduction. As simple as that. All the gains in this chapter are transferred to capital reduction account, land and building account, debit. Yeah, our asset is increasing, our land and building value is increasing by 3 lakh. So if your asset increases, yeah, what do? Debit. Yeah, asset value increases, you have to debit that. Land and building account, debit 3 lakh to capital reduction account. That gain will be transferred to capital reduction account. Simple as that. 3 lakh. Yeah, and then everything is over. Yeah, then the last thing, see here, the amount thus made available is utilized to write off all intangible and fictitious assets. Now here in this question, the intangible assets are two. See here, patents and goodwill. Yeah, now how this loss making company of Nischal Limited, how can it have goodwill? It can't have goodwill. So every time whenever there is given goodwill in internal reconstruction, you have to write it off, you have to scrap it off. Okay, even patents also. Fine. So that's what we are doing here. We have to write off all intangible and fictitious assets. Fictitious assets means what? It is the assets which don't have any value, right? Such as profit and loss debit balance here in this question, preliminary expenses, yeah, discount on issue of shares, all these things, underwriting commission. Now here we have only one fictitious asset, that is profit and loss, accumulated loss, right? It's a loss, it's debit balance, it's on the asset side, right? So this is what we have to write it off. And then they have said, and to bring down the value of plant and machinery by 40%, right? So now they are saying plant and machinery is overvalued than what it's supposed to be. Yeah, its value is not 10 lakh, it has to be reduced by 40%. It is overvalued, it is overvalued. Yeah, so what we have to do is we have to reduce that. So now we have to pass a club entry of capital reduction. See here, this entry, it's very simple to pass. Yeah, what are we going to do here is we are going to utilize the amount, the gain that was there in capital reduction to write off the losses, fictitious assets, intangible assets, and properly value the assets and everything. And if there is any balance left, that balance will go to capital reserve, right? So see here in the previous entries, what we did in the previous entries, if you see, we credited the capital reduction account everywhere, right? We were gaining here, here. So all that gain used to go to capital reduction. Yes, it used to be credited. Yeah, 3 lakh credit, here 6 lakh credit, here 75,000 credit, yeah, 80,000 credit, and here 3 lakh credit. So the capital reduction account was increasing. So if we see how much amount do we have in capital reduction, see here, capital reduction account credit 3 lakh. So 3 lakh plus, then if you see here, we have 6 lakh capital reduction credit. So 6 lakh plus, and then here 80,000 plus 80,000, then plus how much here, 75,000, then plus here 3 lakh, yeah, plus 3 lakh. So in total we have how much? 13,55,000 gain in where? In capital reduction account. Here it was getting credited. Now that capital reduction, we are using it, we are utilizing it to write off losses, intangible, fictitious assets and everything. Yeah, so we have to utilize it, we have to use it. So here it was credited. Now to use it, we are going to debit that. Capital reduction account debit 13,55,000. Yeah, the total amount you are going to take, whatever that is there on the credit. Yeah, on the credit side of capital reduction, whatever that is there, you are going to take it to the debit, capital reduction account debit. You're closing of the capital reduction account and you're utilizing it to write off everything. Yeah, and then if there is any balance left, that will go to capital reserve. Simple as that. So see here, what we have to write off, as said in the question, we have to write off, whether said in the question or not, you have to write off the intangible and fictitious assets, right? Goodwill and patents, 2 lakh, 1 lakh 50. Now these are assets. To write off the asset, to decrease the asset, to reduce the asset, you have to credit them. Simple as that. So what are you going to do? Capital reduction account debit. Yeah, you're closing it off, you're cancelling the capital reduction account now. This was a temporary account which we opened just for internal reconstruction. Now we have to close this account. So we are debiting that by the total amount, whatever that is there on the credit side. And then one by one, we have to do whatever that is said in the question, right? So first, write off intangible and fictitious assets, right? 2 patents, 1 lakh 50 as given in the question. Credit the patent, credit the asset to scrap it off. Yes, and then goodwill also. So goodwill is 2 lakh. Yeah, so that asset is reducing now, we are scrapping it off, we are reducing it, so credit that 2 lakh. Simple. And then profit and loss account, this is accumulated loss, fictitious asset, right? So we have to do what here? We have to credit that. Yes, this is a debit balance, profit and loss, it's a loss. Yes, it's a loss making company, it's a loss that has been accumulated and capitalized in the balance sheet. Now we have to write it off, we have to remove it from balance sheet. So to write off that which has debit balance, you are going to credit that to profit and loss account, 5 lakh. Then they have said, see, reduce the value of plant and machinery by 40%. Simple. What is the book value of plant and machinery? 10 lakh. To reduce it, what you have to do, you have to credit that, and by how much? By 40% you have to reduce. So 40% of 10 lakh is what? 4 lakh. Simple. Yeah, 40% of 10 lakh, 10 lakh into 0.40, it's a 40%, right? So that's 4 lakh. So you are going to reduce the plant and machinery by 4 lakh. Simple. Yeah, and then if there is any balance left, you have to transfer it to capital reserve. Yeah, it will go to capital reserve. Yeah, there will be a lot of gain here, right? If there is any amount left in the capital reduction, that has to be transferred to capital reserve. Now how are you going to know that? It's very simple. Just find out the balance. See, we had 13 lakh 55, we saw that 13 lakh 55 in the capital reduction, and then we used for patents, goodwill, profit and loss, plant machinery to write off. So deduct all that, minus 1 lakh 50 from patents, and then 2 lakh for goodwill. Yeah, and then minus profit and loss 5 lakh. Yeah, then minus plant and machinery 4 lakh. Yeah, after that you get 1 lakh 5,000 as the balance. Yes, the credit side is short by 1 lakh 5,000. There is a balance on the credit side here, so that balance has to go to capital reserve. Simple, because this is of capital nature, so it will go to capital reserve. Simple as that. That's what you have to do. It's easy, right? First transfer whatever gain you get to capital reduction, and then utilize that gain to write off the intangible, fictitious assets, accumulated losses, and properly value the assets. And if there is any balance, that would go to capital reserve account. Simple. You got this? Now based on these journal entries, we have to see the balance sheet. We have to see how to create the balance sheet after reconstruction, internal reconstruction. Now let's see the balance sheet. Now here we have the balance sheet of Nischal Limited. So let's see how to prepare the vertical balance sheet after internal reconstruction. See, it's very simple. All you have to do is you have to look in the journal entries and the old balance sheet. On the basis of this, you can easily prepare the vertical balance sheet, right? So see the format is very simple, right? We have got particulars column, note number column, and amount column, isn't it? Equity and liabilities, assets. In equity and liabilities, what do we have? Shareholders funds, non-current liabilities, and current liabilities, the main heads, right? And in the assets, non-current assets and current assets. Simple. Yes, so let's start. See here, first what do we have to take? Shareholders funds, share capital, note number 1. So you don't write anything over here first, right? You have to leave that empty. First do the note number 1, share capital. So what do we have in the old balance sheet? In the old balance sheet, if you see, in the old balance sheet, we have got what? In the old balance sheet, you see equity shares and preference shares. But now in this scheme of internal reconstruction, we have made changes to that. We have changed the face values and the percentage of preference shares, right? Isn't it? Yes, see here, equity share. What happened to equity shares? Let's see that first. Equity shares, yeah, we changed their face value from 10 rupees to 5 rupees, isn't it? So what would be happening now is the number of equity shares are same, but the face value has been changed. So 1,20,000 equity shares are there. Yeah, number is same, of rupees 5 each, fully paid. That's what you have to write. What is there now? Yeah, in what condition equity share capital is now, you have to record that. Simple. Yes, we have changed the face value, isn't it? We scrapped off the old capital and we created the new capital at the face value 5, isn't it? 1,20,000 shares at rupees 5, that was 6 lakh. So that's what you have to take into the notes to account. Yeah, equity shares, 1,20,000 equity shares of 5 each, that is equal to 6 lakh, isn't it? See here, it's very simple. 5 into 1,20,000 equity shares, that's equal to 6 lakh. Yes, so 6 lakh would be the equity share capital. And then preference share capital. Preference share capital, in the question we had what? We had how much? 12% preference shares of 100 each, but we changed it, we made it 15% at 75, isn't it? So that's what you have to take. So 12,000 preference shares were there. Yeah, now we have converted them into 15% preference shares, from 12% 15%. So now it is 15%. So 15% preference shares of rupees 75 each. Yeah, so we have changed the face value. So 75 is the face value into the number of shares, 12,000, that is equal to 9 lakh. So 9 lakh would be the preference share capital. Simple. And if you add them up together, that's 15 lakh. 9 lakh plus 6 lakh, that is equal to 15 lakh, right? That's the total share capital. So that's what you have to take here. Then reserves and surplus. So do we have any reserve in the old balance sheet? No, we don't have any reserves, right? Yes, we do here in profit and loss, that's debit balance, right? But we have written that off, right? Yes, we have written that off, but in the answer, what happened in the answer, in the journal entries, what happened at the last entry? At the last entry, what happened? The capital reduction, there was balance left in the capital reduction, and that extra balance has to go to capital reserve. Yeah, how much went to capital reserve? 1,05,000, right? So now this 1,05,000 has to be recorded in the new balance sheet. Yes, we have got a reserve now, capital reserve of 1,05,000. So that is what we have to take it in the new balance sheet. Reserves and surplus, note number 2, leave it empty. Write it over here, note number 2, reserves and surplus. What reserve? Capital reserve. From the journal entry, 1,05,000. Simple. Right, that's it. And then what do we have? Then non-current liabilities. Do we have any non-current liabilities? See in the old balance sheet. In the old balance sheet, we have got non-current liabilities. See here, 10% debentures, 8 lakh. Right? So what happened to these debentures? Have we made any change to that? Yes, we have. See, the C question, debenture holders agree to forego interest outstanding. Yeah, that's different thing. That the rate of interest be increased to 15%. We change just the rate of interest. Yes, from 10%, the rate of interest became 15%. That's it. So that's all you have to do. So the amount has not changed. It's same. So non-current liabilities, long-term borrowings. Debentures are long-term borrowings, right? It's meant for long term. So long term borrowings, note number 3, and it's a secured loan, isn't it? So that's why secured loan, 15% debentures. Yeah. Now before in the old balance sheet it was 10% debentures, but now in the internal reconstruction scheme we have changed it to 15% as given in the question, 15%. So that's what you have to take, 15% debentures. Okay, 8 lakh. Simple as that. It's very easy. You just change the percentage. That's it. 8 lakh. The amount is same only. In the old also it was 8 lakh. Now also it's 8 lakh. Yeah. Right. And then what happened? Then see, in the old balance sheet you have got outstanding interest on debentures, but this outstanding interest on debenture is gone now, right? It is gone. We have, thrown it out of the balance sheet. It's no more because we have settled it with the debenture holders, right? Yes. Then what do we have got? See here, current liabilities. Do we have any current liabilities in the old balance sheet? Current liabilities, yes, we have. We have 2 current liabilities, bank overdraft and sundry creditors, isn't it? Now sundry creditors will come under head of trade payables. Note number 4, trade payables, sundry creditors. Now in sundry creditors we have made a change, isn't it? Yes, we have. See here, in sundry creditor what happened? If you see in the journal entries, what happened was sundry creditors. Yeah, sundry creditors, we made a deal with the sundry creditors and they forgave their 25% claim. Yes, our liability to sundry creditors reduced by 25%. We made a deal with the sundry creditors, isn't it? So 75,000 liability was reduced, 75,000 creditors were reduced. So you have to record that in the new balance sheet. So creditors before they were 3 lakh, in the old balance sheet they were 3 lakh, but then we made a deal with the creditors and we asked them to forego their 25% claim. So 25% of 3 lakh is 75,000. So we deducted that. Our liability reduced. Yes, our liability reduced. So 3 lakh minus 75, that is equal to 2 lakh 25, isn't it? See here, 3 lakh was our old creditors and then we asked them to, forego their 75,000 claim. That's how much? 25%. Yeah, it was 25%. Yes, 25%. So then our new creditors amount would be 2 lakh 25,000. This is our liability. So now this new liability has to be recorded. Yeah, the updated one, right? So 2 lakh 25,000. And then what do we have? Yeah, the liability section is over. So just add it all up, right? So 15 lakh. Sorry, there's bank overdraft. So bank overdraft, you don't have to take another note for that. Yeah, it's only a single thing and you don't have to show anything. So bank overdraft 60,000 as given in the question. That's it. See here, bank overdraft 60,000. Yes. So whole liability thing is over. Yeah, whatever that was there, it's over. Now you will be asking outstanding. Oh, that is gone, right? We have settled with the debenture holders. We don't have to pay that outstanding interest on debentures, right? So that is removed. Okay. And then bank overdraft, exactly copy it down because nothing happened with the bank overdraft. So bank overdraft is still there, 60,000. Fine. So if you add it up now, see here, 15 lakh plus 1 lakh 5, yeah, reserves and surplus, plus 8 lakh of what? Debentures, long-term borrowing, plus 2 lakh 25 of what? Trade payables, plus bank overdraft 60,000. That is equal to 26 lakh 90,000. Yeah, 26 lakh 90,000. That is your what? That is your total of equity and liabilities. Fine. Right. Then what do? We go to the asset sides, right? So asset side, look into the old balance sheet. What assets do we have? Goodwill. Now, do we have goodwill anymore? No, it's gone, isn't it? We have return of the goodwill entirely here. right? Goodwill is completely gone. We have to do that in internal reconstruction. Whether the question says or not, you have to write off what? Fictitious assets, all fictitious assets, and then all intangibles, yeah, goodwill and patents and all, copyrights, trademarks, everything, and then you have to write off all accumulated losses. So all these things are gone, right? What is gone? Goodwill is gone. You don't have to record that. Yeah, patents is gone, and then here what? Profit and loss debit balance is also gone. Yeah, accumulated loss. So these three things you don't have to record: goodwill, patents, profit and loss. It's gone. Fine. So you will not take that. Remember that. So non-current assets, current asset. That's what we have in asset side, right? In the asset section. So now see here, non-current, current asset. In non-current asset, what comes? Fixed assets. Under that head, tangible assets, intangible assets. Yes. Now tangible assets are what? Tangible assets are the assets that have physical existence, isn't it? So land and building, plant and machinery, and furniture. Where is it? Yes. Land and building, plant and machinery, and furniture. These are tangible assets, the assets which have physical existence. Fine. So now 12 lakh. So did we change any value of land and building? Yes. Land and building was appreciated. The value was increased. Land and buildings was valued at 15 lakh. Its value increased by 3 lakh, isn't it? So we have to record this new value, land and building, at 15 lakh. Understood? It has increased. It has increased by 3 lakh. So see here, tangible asset, note number 5, leave it empty, go to the note number 5, tangible fixed asset, land and building. Its value was 12 lakh before in the old balance sheet, but then in the additional information they said the value is 15 lakh. So that is what you have to take, 15 lakh. Its value increased by 3 lakh, simple. Then next is plant and machinery. We have plant and machinery. Plant and machinery value was 10 lakh in the old balance sheet, but then in the additional information what they said, see here, plant and machinery, reduce the value, bring down the value of plant and machinery by 40%. Plant and machinery was overvalued. So what we have to do? We have to reduce the value by 40%. Simple. So we did that. It was 10 lakh. The value was 10 lakh of plant and machinery. We reduced that by how much? By 40%, isn't it? In this entry, plant and machinery, we reduced that by 4 lakh, 40%. Yes. So that's what we have to record. Plant and machinery, 10 lakh minus 4 lakh. Okay. So the new value of plant and machinery is 6 lakh, the correct value. Fine. And then nothing happened to the furniture, right? Whatever the furniture was there at whatever value in the old balance sheet, the same thing you have to take in the new balance sheet. See here, furniture 3 lakh, furniture 3 lakh. No change in that, because in the scheme there was no mention of furniture. We didn't do anything to furniture. So take it as it is, 3 lakh. Then if you add it all up, see here in the notes, 15 lakh of land and building, plant and machinery 6 lakh, and furniture 3 lakh. If you add it up, see here, 15 plus 6 plus 3, that is equal to 24 lakh. Yeah. So 24 lakh would be the total of tangible fixed assets. And then what do we have? Current assets. Now in current asset, what comes under current assets? Yeah, trade receivables, inventories, cash and cash equivalents. Now here we have intangible also according to the format, but do we have any intangible assets? See, in the balance sheet we had intangibles, goodwill, yeah, and then patents and patents, yeah. So these were intangibles, but we have written them off. Yeah, they are cancelled over here. They are no more there in our business. Fine. Clear? Right. So that's what happened. So that's why you don't have to take anything intangible, nil. Fine. Then current asset, in current asset we have got trade receivables, inventories, cash and cash equivalents. So trade receivables, note number 6. It's simple. Trade receivables means what? The receivables, right? We have got debtors, sundry debtors. How much? 1,30,000. Have we made any change to that? No. Just take as it is, right? So sundry debtors, 1,30,000. Simple. Trade receivables, sundry debtors, 1,30,000. That's it. And then note number 7, see here, inventories. We have got inventory, right? Stock is there. How much? 1 lakh. So take it, inventories, note number 7, inventories, stock. How much? 1 lakh. Same as it is. Yeah. No change in sundry debtors, no change in stock, no change in furniture. Yeah. So no change is there. You have to record it directly, whatever that was there. Fine. Okay. And then cash and cash equivalents. So do we have any cash? Yes, we have cash at bank. Yeah. So how much is it? 60,000. So same thing, no change in the cash and cash equivalent, 60,000. Simple. So this is how you have to do the balance sheet. On the basis of what the question, yeah, the old balance sheet and what is said, what has happened, and you can also take the help of what? The help of journal entries, because here if capital reserve is there, you will get to know over here, right? Capital reserve, you have to record it in reserves and surplus, isn't it? Yes. And then what has happened, how much things you have written off over here, what you have decreased, yes, and what all things have happened over here, you will understand here, right? Here we didn't pay the interest, We didn't have to pay the interest. It is foregone by the debenture holders. So it's no more a liability. If it's no more a liability, then we don't have to record it in the balance sheet. So that's why I didn't take outstanding interest. Outstanding interest was there in the old balance sheet. It was a liability. It was. Now it isn't, because debenture holders have made a deal with us and they have foregone the outstanding interest. So it's no more a liability. Yeah, that's all. And then we reduced here sundry creditors, right? Here it is debited, so it is reduced by 75,000. So we did that in creditors, we reduced that. Yeah, and here land and building was debited, so it was appreciated, it was increased by 3 lakh. So the new value of land and building was 15 lakh, directly given in the question, directly you can take. Yeah, it's very simple. Fine. So this is what. So let's add up the asset column. See here, what do we have? 24 lakh of tangible. Yeah, 24 lakh of tangible assets. And then what do we have? 1 lakh 30 of trade receivable, 1 lakh 30 trade receivable. And then we have inventories of 1 lakh. Yeah, and then 60,000 of cash. If we add up all together, that's equal to 26 lakh 90,000. It tallies, right? So this is how you have to go about it. It's very simple. Okay, it's very simple. The format also, don't worry about the format. It's very simple format. If you solve 2-3 problems, you see this right format right regularly, then you will feel this is very easy. What is there? Equity and liability, shareholder funds, non-current liabilities, current liabilities. In shareholder fund, what is there? Share capital, reserves and surplus. In non-current liabilities, long-term borrowings. Yeah, in current liabilities, trade payables, bank overdraft, other current liabilities, yeah, short-term provisions, whatever it is there, it will come. It's very simple. If you solve more and more problems, you will feel this is very simple. Okay, and then in assets also, non-current assets, current assets, fixed assets, another head, okay, subhead, and then tangible, intangible. Yeah, and then current asset, trade receivable, inventories, cash and cash equivalents. It's very simple. Yeah, okay, then see you in the next video. You understood this, right? Yeah, okay.